Legendary investor Michael Burry, known for predicting the 2008 housing crash and investing in GameStop before it became a meme stock, has significantly adjusted his portfolio. According to Bloomberg data, Burry reduced his stock holdings from $102 million to $53 million in the third quarter of 2024, as revealed in his latest 13F filing. Notably, he has offloaded some of his largest positions, including cutting his stake in banking stocks by 90%. Although Burry has made a few new investments, the third quarter of 2024 marks a major shift in his investment strategy and outlook for the U.S. economy. Burry's largest reductions were in U.S. stocks, which comprised 37% of his portfolio, selling about $38 million worth. This raises the question of whether Burry has turned bearish on the U.S. stock market, especially with increasing speculation about a potential recession. While 13F filings don't reveal the reasons for specific transactions, analyzing the sectors Burry reduced can provide insight into his rationale. At the end of the first quarter of 2024, Burry's portfolio was heavily allocated to consumer discretionary, financial, energy, and industrial stocks, sectors that are sensitive to the business cycle. Consumer discretionary stocks, for example, depend on strong consumer spending, which typically declines in a weakening economy. Banking stocks are vulnerable to financial stress, which tends to increase with loan defaults during economic downturns. Energy and industrial stocks also perform better when economic activity is robust, as these sectors thrive when goods are being produced and transported. However, by the second quarter of 2024, Burry reduced his exposure to consumer discretionary stocks by 30%, financials by 90%, and completely exited energy and industrials. Instead, he began increasing his position in consumer staples, a defensive sector less affected by economic fluctuations. He also maintained exposure to communication and technology stocks, which are similarly less sensitive to the business cycle. Overall, this shift indicates that Burry is moving away from sectors vulnerable to economic weakness and towards more defensive areas of the market. Burry's total stock holdings declined from $102 million in the first quarter to $53 million by the third quarter. While he hasn't commented directly on this reduction, such a significant sell-off typically suggests a less optimistic view of the markets. However, it's important to note that Burry isn't shorting the market as he did ahead of the 2008 financial crisis. His portfolio remains long, meaning he still expects some stocks to rise, and his major focus is on Chinese tech stocks. During the third quarter of 2024, 3 of Burry's largest holdings were in Chinese tech companies, which now account for 46% of his portfolio. He increased his position in Alibaba by 24%, adding 30,000 shares, and boosted his stake in Baidu by 87.5%. Baidu is a significant player in AI and internet services in China. One reason for this shift could be the valuation disparity between US and Chinese stocks. Chinese stocks are currently at their lowest price relative to US stocks in over 15 years. While concerns persist about China's economic outlook, including government crackdowns and a real estate crisis, Burry may believe these risks are already reflected in the low prices, presenting a buying opportunity. If China's economy stabilizes, these stocks could experience a sharp rise, aligning with Burry's contrarian investment strategy. However, this approach carries risks. The cheap valuations in Chinese stocks could signal value traps where stocks remain undervalued due to poor growth. Alibaba and Baidu, leaders in e-commerce, cloud computing, and AI, have strong growth potential, but the uncertainty surrounding China's real estate market remains a significant risk. If China's recovery mirrors the US post-2008, these stocks could surge. But if China follows Japan's stagnant recovery path, it may take decades for a rebound. In a surprising move, Burry also sold his entire gold allocation. Previously, 7% of his portfolio was invested in the Sprott Physical Gold Trust, which provides direct exposure to gold prices. Gold is often viewed as a safe haven asset, holding or increasing value during market volatility and economic uncertainty. By selling out of gold, Burry may be signaling that he is not overly concerned about an imminent economic collapse or severe market downturn. In summary, Michael Burry has significantly reduced his U.S. stock holdings, reallocating his portfolio toward undervalued sectors, particularly in China, where he sees better returns in the current environment. He hasn't taken a short position like he did in 2008, and his decision to sell his gold holdings suggests he may not be expecting a major crisis in the near future. Overall, Burry appears cautious but not entirely bearish.